Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Chewy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Chewy is an online retailer of pet food and other pet related products. It also has a pet pharmacy offering prescription medications. In 2017, it was acquired by PetSmart for $3.35 billion, which was the largest ever acquisition of an e-commerce business at the time. The company is headquartered in Dana Beach, Florida, and was founded in 2011. The ticker trades on the New York Stock Exchange and Mexican Bolsa. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $28 a share and they have 421 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they finally had positive free cash flow in 2021, also another really small positive in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative each year, although the negative is getting smaller. Revenue is the sales for the company, and that grows a lot from 3.5 billion to nearly 9 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and you can see that tripled from 700 million to 2.4 billion. And it's obvious they're improving on a nominal basis. Tripling their gross profit is really good. But to really understand if they're improving, we need to look at their gross profit as a percent of revenue. And that has been improving from 20% to nearly 27%. You would expect your margins to increase as your revenues increase, since economies of scale set in. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue, such as marketing. Since their operating expenses are higher than their gross profit, they have negative operating income each year. But the negative is improving. They spent 1.6 million of interest on their debt, which is less than 2021, but a lot higher than 2019. Then you have your pre-tax income. They're not paying anything in taxes since they're not making any money. And the bottom line of the income statement is their net income, which is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They did have a negative in 2019, but it's nearly 200 million in 2022. So that looks really good. But they do spend a lot in CapEx each year, over 180 million in 2022. Operating cash flow minus CapEx gives you your free cash flow. And they are cash flow positive in 2022, also in 2021. But they did have a negative in 2019, negative 58 million. They're mainly using stock to fund their growth. They added 110 million of stock in 2020 and 318 million in 2021. Every time a company adds common stock, it increases the shares outstanding and makes your shares less valuable. Let's look at the capital structure. They have 15 million of equity and 410 million of debt. They're 3% equity, 97% debt. And they could pay off all the debt with the cash on their balance sheet and still have 193 million of cash left over. I gave them the highest whack on Finbox, 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 18 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $15 billion. We divide that by 421 million shares. And we get a calculated stock price of $37. They're trading at $28. So they're trading at a 24% discount. It's a buy according to the model. The company's revenue target in 2025 is 13.1 billion. And for 2024, it's 12 billion. For 2023, it's 10 billion. And I continued this growth into 2026 and I got 14.4 billion. That's how I got their future revenue estimates. The average company in their industry converts 10% of their revenue into free cash flow. So I multiplied their 2026 revenue by 10%. That's how I got their future free cash flows. And I multiplied their 2023, 2024, and 2025 revenue by 5%. That's how I got their free cash flows for those years. Simply Wall Street values the company at $79. They're saying it's 70% undervalued. 18 analysts priced this stock and the average price target is 50, the low is 23, the high is 133. It looks like the stock IPO'd around $40 and then right off the bat it dropped a lot. It looks like it might have fell below $15 and that was at the end of 2019. Then the stock went up about 800% from the bottom to nearly $120 a share. And this is in the beginning of 2021. But you can see over the next 12 months it just kept going down and down and down. So the question to ask you, is this the bottom or is there more downside? It looks pretty low. It's getting close to its all-time low. So there could be some major upside with this stock, because we know the pet food industry is a really big market. They have a beta of 0.74, so the stock is not too volatile. It moves less than the market. It's gone down 69% in the past 52 weeks, while the S&P is down 2%. The 52-week low is 22, the high is 98. And the stock is trading well below its 50-day and 200-day moving average. 5 to 6 million shares are traded each day on this stock. Almost all the shares are held by institutions, but it has a really high short percentage. Almost 26% of the shares on float are shorted. If you put $10,000 into this company when they IPO'd, you would have tripled your money after about a year and a half. But if you're still holding on, you'd be under $7,000. That's a 30% loss. The CEO's annual salary is $1.2 million, and their total compensation package is over $12 million. Look at their total compensation package in 2020, $150 million. When you buy a stock, you'd like to see insiders also buying the stock, not selling the stock. But in the past 12 months, there have been lots of insiders selling, only one buy. And look at these sales, $75, $78, $55. All these people sold well above what it's trading at now. So they could buy back in at a lower price if they wanted to. 75% of the stock is held by private companies, 25% by institutions, and 0.4% by insiders. Their employee count has been going up nicely over the years. They're currently at 21,300. The biggest shareholders are Argos at 78%, then Morgan Stanley, Bailey Gifford, Brown Advisory, and Vanguard. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They do have a good price to sales of 1.3, that's stock price over sales per share. That means investors are paying $1.30 for $1 revenue. The way you calculate sales per share, it's revenue over shares outstanding. They don't have much equity on their balance sheet, so they have a really bad price to book. And they have a really small amount of free cash flow, so they have a terrible price to free cash flow. Their current ratio is 0.8, that's current assets over current liabilities, and a quick ratio of 0.5. They only generated $9 million of free cash flow in 2022, and they have negative $321 million of working capital. Working capital is current assets minus current liabilities. So it looks like the company's going to be short, so they're going to need to add some debt or equity this year to fund their operations. The best way to look at ratios to compare them to companies in the same industry. There are 51 companies in the same industry as Chewy, and if Chewy has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend less in CapEx than the average company. That's mainly because Amazon is dragging up the average. They have a really bad debt to equity ratio. For every dollar of equity, they have $28 of debt. They just started generating free cash flow, so it is smaller than average. Of the 51 companies, they rank 9th in market cap. Their price to book is a lot worse than average. We can't look at their PE since they have negative earnings. A really bad price to free cash flow. When a company has negative earnings, you look to the price to sales ratio, because price to sales can never be negative, because you can't have negative revenue. And they do have a good price to sales of 1.3, which is better than the average of 1.6. They generate $9 billion of revenue, which is less than average. They haven't been public for 5 years, so we don't know their 5-year annual revenue growth rate, but I'm sure it's bigger than average. And they have a negative ROA and ROE. So to summarize, I have them trading at a 24% discount. And I really like Chewy. I'm a customer. I get my dog food from this company. They really have good customer service. They were ranked by Newsweek for 3 straight years as having the best customer service. And they sell more animal food than any other company in the world. So I think this company has great potential. Once they become consistently profitable, I believe they'll start paying a dividend as well. I rank their free cash flows 4 out of 10, their revenue 8 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.